Hi, I'm Max Miorada, today's guest for the Property Investing Roadmap podcast, Lending in a Changing Market, What Borrowers Need to Know in 2026. I just wanted to jump in here to share this episode was recorded before the Australian federal budget proposed changes to negative gearing and capital gains tax. So anything you hear into the episode about either negative gearing or CGT still applies to existing investors and new builds. So if you have any questions after today's episode, please reach out and enjoy.
The lending landscape is one that continuously shifts due to changes in economic conditions, borrower behaviour and risk. We've seen changes to debt-to-income lending, tighter rules around borrowing through trusts and companies, and interest rates that are continuing to put pressure on household budgets. So what does all this mean if you're trying to buy, invest or refinance? Today we're breaking it all down and explaining what's really happening in the market, how to navigate lending changes, and what borrowers need to understand in a changing market. Today's episode is focused on finance for investments and it was spurred on by a listener question. The question is, with changes to trust and company lending, can I still borrow through a trust or company, or is it basically now off the table? We'll unpack this along with other key finance questions about lending in today's market. Here to help unpack it all is Max Miorada. He's a senior credit advisor with Momentum Wealth. Max is ranked in the top 1% of brokers nationally, and last year he settled more than $112 million in loans. Max, welcome to the show.
Thanks for having me, Damian.
Now, lots to talk about today. There is lots of changes continuously happening in the finance market, and we're going to try and unpack a lot of that today. But we talked, first of all, the question from the listener was about company and trust borrowing. Now, that'll be different through the different lending cycles, but do many people try to borrow and invest through trusts and companies?
Yeah, there tends to be quite a large amount of people that try to at least. We have people coming to us all the time trying to optimize their investment portfolio. They want to get the best outcome on tax, on borrowing capacity. And quite often, and it's definitely a bit of a new trend as well, though, people are coming to us wanting to invest in a trust or a company. So for us, it's often just having the discussion about the pros and cons from the finance side and then incorporating that with a discussion from the accountant, because there's pros and cons on either end, and then you need to incorporate your investment and long-term goals. So it's very much a collaborative discussion, just trying to get, exactly where the best outcome is for the customer, matching those things together.
And putting my reformed accountant hat on, I can certainly, look, they can be great investment vehicles, particularly trusts, but you've got to be able to inject the income into it. And that's the key thing. If you're on a salary and you want to negatively gear your residential investment property, you can't do that in a trust unless you can inject income. So for business owners, they make sense. For individual investors, perhaps there's land tax and other things, but that's, again, a great discussion with accountants. Now, if I want to borrow in a trust or company, how is it treated differently in the way they assess loans? And perhaps you can talk about, obviously things change in the market, but some lenders don't always lend to those sort of structures, do they?
Mm-hmm. No, that's correct. And the point you touched on before about negative gearing is an important one, because for those who don't know that are listening, if you're running at a cash flow loss on an investment property, that loss is offset against your income, right? So if your taxable income is $100,000, you'd make a $10K loss on a property. It's now brought down to $90,000, and you're essentially getting a tax refund at the end of the year, depending on what your tax rate is, right? If you're investing in a trust or a company, the losses are trapped within that entity and therefore can't be distributed to yourself. So the way the lenders look at it is that they will negative gear your income if the investment lending is in your name. If it's in an entity, it's not. So the difference in borrowing capacity is quite substantial. And to give you a brief example, so if I've got $1 million of investment lending and I want to borrow more, you could, so if it was in an entity, you can borrow about $1.9 million it is, based on a few other variables. And then if I was to swap the investment debt to deductibles, so in their personal names, then lending capacity would jump to $2.7 million.
Yeah, that's substantial, isn't it? That's
quite
huge.
a large disparity.
Yeah.
Yes.
And what about if someone was self-employed and could funnel income through that trust? Do they then give them the negative gearing credit for that, or is it still assessed as, no, that's a standalone?
Still assessed differently.
Yeah, right.
Yeah.
That's interesting. So while from a tax point of view it might make sense, it might also mean you can't get that next investment property.
Correct. $800K is the difference between another property or a much more superior property. And I've seen it firsthand. A lot of people set up the entities. They come to us. They've already set them up. They've already put an offer on a property. They've already got a property in the entity. And they do get to a point where there's essentially a roadblock. I want to borrow more, I want to get more investments, but I can't. So that's when the collaborative discussion between advisors is really important.
And there's also there's so much to consider as well as negative gearing. There's also land tax. If you've got multiple investment properties in your own name, and particularly if they're all in one state, you're going to get hit with potentially quite a significantly higher land tax as well. So, whereas if you put it in a trust, that's a separate entity. And in some states, you get that extra threshold again to start utilising the land tax exemption. So it's quite a complex process to think about. And I agree. I think anybody looking to borrow, to invest, you get the structure right first before you actually go out there and start looking at properties, because that's obviously impacts your borrowing capacity and quite significantly, but also impacts a whole lot of other things, doesn't it?
That's right. It's very important. And the countless times that I've seen people, they're stuck and they can't invest any further because they've done it in the entities. Recent time, a client actually, they're about to finish a construction in an entity. They've decided they want to live in the property, right? And if they live in it and it's in the company, they're not getting the capital gains tax exemption. So they're actually looking at transferring it out and paying stamp duty.
Paying the stamp duty, yeah.
Yeah, you need to make the right decision early on or it can hurt.
And that's another thing with a trust. You get a capital gains discount that passes through to the individual beneficiaries of that trust. With a company that's stuck in there, no capital gains discount at all. So just always remember that. So there's a lot of complexity to it. As I said, we want to see people go and talk to their finance advisor first, but in collaboration with the accountants, get that sorted first before you start looking at properties. That's really critical. So how does the debt to income ratio or test apply? What does that mean, and how do lenders assess it? And is there quite a differential in the way each lender assesses what's a limit that someone can borrow?
Yeah, so debt to income in simple terms is the amount of debt that you have relative to the income that you're earning. So if my debt level is $1 million and I earn 100,000, my debt to income is 10, right? Whenever you get to say 6 or above, or you start creeping above 6 towards 7, a lot of the lenders imply different, or they say risk mitigation tools. They say you can only do X or Y in this certain circumstance because you're a higher risk based on your debt to income. So it's quite common to see high debt to income ratios at the moment with people specifically that have large portfolios. The reason being is, and to clarify, the debt to income ratio is based on your current income, but the way the bank assesses it. So it's quite common to see people with 6 or 7s and even pushing above that, and the lenders will lend the money, but their personal position is much, much better than what the banks are saying, because the banks are shading your rental income, right? Whether it's to 90%, 80%, 70%, they're shading your bonus income, and they will use those figures as part of the debt to income calculation. So you may be able to afford something quite easily, but the calculations the banks are using isn't quite as okay.
And does that vary quite a lot across the different lenders? I mean, you've got access to 40 odd lenders. Is the way they assess these things quite different depending on the lender?
A lot of the major banks and the second tier lenders, they assess it very much the same. It's the third tier lenders that aren't, they're not deposit taking institutions. They're not big banks. They get their money from investors and mezzanine funding. And they're the ones that can be a bit riskier with their products. So some of them won't shade bonus income or won't shade rental income. However, you pay with a much higher interest rate. So they're very common at the moment when borrowing capacity is constrained. People utilize them quite often.
And talking about that debt to income ratio, does that matter? Do they put more risk on if it's all predominantly investment versus owner occupier, or is that not really any difference in the way they consider it?
It's not too different. It's the total debt, total income. So, but of course, the more investment properties you have, the more risk there is, and the higher the ratio is because you're using rental income in your serviceability calculations.
And I think one thing a lot of borrowers don't understand is the higher interest rate that the lender assesses you on, rather than what you're actually paying. And does that even apply if I fix a loan? So let's say, hypothetically, I can get a fixed rate at 6.25%, but will the lender still, for 5 years, will the lender still assess me at that plus, I think it's plus 3% is the norm, or do they actually assess it at the rate I would take if I fix my rate?
Most major lenders will use the buffer. It's the non-bank lenders, albeit some bank lenders will take it at face value, but generally not. They'll do the plus 3% buffer, and the non-bank lenders will, they'll accept it at face value, and that's it. They can be a bit riskier, and therefore their rates are higher. So that's the trade-off there.
Because that's if you're talking about an interest rate of 6%, just as an example. I mean, that's obviously will go up and down in the cycles. But if you're getting a 3% buffer on top of that, 9%, that's 50% more than you're actually currently paying. That's huge, isn't
It's
it?
significant.
Yeah.
Yeah, and the banks have all these buffers in place, and APRA, the governing body, have they introduce these sorts of things to mitigate risk in the market. They don't want people over leveraging, taking unnecessary risks. They don't want the bank taking unnecessary risks. So they introduce these things like the 3% buffer, which used to be 2.5% a couple of years ago, right? And so they are assessing you at 3% higher. Are we going to see 9% interest rates? I hope not. Probably not. You might be able to provide a bit of clarity on that because, well, I mean, what was the highest rate you had back in the day? You've been around a while.
Oh,
We used to get
thanks,
double
Max. I have been,
digits.
no, definitely. My parents had 18%. I was
Yeah.
way too young for that. I do.
Okay.
I'm not that
You
old,
were
but
safe. Yeah.
yes, no. I remember my parents paying 18% back in the early 90s, and look, I've seen 8-9%. Yeah, there's been a different cycle, but certainly, I think occasionally 10 over the journey, but nothing like 18%. I don't think we're going to go back to that. But look, interest rates. We had that glory period, as we all remember, where interest rates, the Reserve Bank rate was near zero. I think we were borrowing at 2.5 to 3. The good old days, and I wish I'd fixed more of my rates then for 5 years.
You and I both.
I think given where the economy's at, I think we'll see ups and downs. But unless inflation was rampant and completely out of control, I don't think we'll ever see 18% again. Let's hope not anyway.
No,
Let's
no.
hope not. And in terms of fixing interest rates, obviously that's a personal decision. But how many clients typically fix, do you find? And what are generally the reasons someone might want to fix their interest rates, other than speculation that they think interest rates are going to go higher?
Yeah, it's a good question, Damian. In the past, I would say 2 years, I've fixed about 3 loans, right? And I have about, say, 120 clients a year that I'm dealing with individually, about 3 times over a couple of years. So at the moment, it's very uncommon, noting that we were in a rising interest rate environment, and they started to come down slightly. But most people would try and do it speculatively. So you'd see people who read an article, they hear about interest rates going up and get a bit spooked, and they go, "Oh, I gotta fix my rate quickly." But that's not usually the best strategy.
Yeah.
So often it's for security of repayment, right? I'm comfortable with my repayments where they are. If repayments went up or the interest rates went up, then I would start to feel a bit of a pinch. I'm comfortable. I will leave it on a fixed rate, noting that we may have fluctuations in the market.
And while we're on the topic of fixed rates, you mentioned there that people see in the paper or the press that interest rates are going up. People forget that the banks aren't entirely stupid. They're also looking at where interest rates are going. So by the time you hear in the press that interest rates are going up, more often than not, the forward rates, so the fixed 3 and 5 year rates, have moved up already, haven't they?
Yeah, correct. And at the moment, they're not really in a position where they're competitive or it makes sense to do it. Because once you fix your rate, you have restrictions to extra repayments. If you want to break it because you need to do something else, you might need to refinance, pull out some equity, buy investment property. You are going to pay a fixed rate cost if the lender is going to lose money on you breaking it. So it's all about their cost of funding, and it's really that flexibility piece. If you're an investor, you've got future plans, you're likely best not fixing your interest rate.
And you mentioned that's important, isn't it? Because if you've got some spare cash, we'll talk about offsets in just a second, but there's generally limits to how much you can pay down off a fixed loan, isn't there?
Correct. Yeah.
And
most will limit it to, say, $10,000 a year.
Yeah, really.
It's minimal,
Yeah.
and you can't offset 99% of the time. There's a couple lenders who allow it. So
do you want to just explain that offset accounts? Obviously, a lot of our clients utilize them, particularly on their home loan. That's the place you generally want to have it in the first place. So, tell me how an offset account works and how that benefits people who've got mortgages.
Yeah, sure. So an offset account is essentially a separate account, right? You treat it as like a savings account, you'd say. So whatever money is in the offset account at any given time, you're not paying interest on that same amount. So if my interest rate's 5%, my offset account has $100,000 on it, I'm essentially saving 5% on the $100,000.
So that's why you'd want to put it, if you had a home loan, put an offset account on your home loan because it's not non-deductible debt. That's the first place I guess you'd put it, isn't it?
Correct. Yeah. And it's actually quite a safe investment when you run the numbers, because you're earning 5% on your money, right? But then you're not paying tax on it. So when you incorporate different taxes, then you're actually earning more than 5% for a pretty safe investment.
And you've still got that flexibility if you need to take it out for some other reason and spend it. If it's in an offset account, it's still your money. So why wouldn't someone use an offset account? Is there any reason generally, if they've already got one, I get it, on a new loan, they probably don't need another one, but why wouldn't someone use an offset account? Is there any reason why they wouldn't?
No, not generally. No, they're very important when you've got investment debt as part of the piece, because if you pay into the home loan, so directly into it, instead of using an offset account, you're essentially paying down the debt in the eyes of the ATO. So you're paying down tax deductible debt versus having the money in the offset account. It's not viewed the same. So you put it in the offset, you can pull it out, the debt stays deductible, versus paying it direct into the loan. So it's actually quite important, if you have a home and you want to pay it off, you pay into the offset, not into the home. I've seen many cases where people have paid off their home thinking it's a good thing, and then they want to turn it into an investment and move into a new home. Well, you've got no tax deductible debt on the home anymore, in which case it's actually better to generally sell it, when you run the numbers, to sell it and then buy the new home unencumbered and then re-leverage to take on more investment debt. So,
And that's important. But yeah, I think you've got to be financially disciplined, because some people are going to look at 200 or 300 grand in a bank account and not be able to control themselves. But if you are financially disciplined, absolutely. If you've got, let's say, a home loan for 800,000 and you've got maybe 600,000 in cash in the offset account, effectively you're still only paying interest on that 200,000 as your home loan. But as you said, Max, if you want to move, now if you've paid that loan down to 200,000, that is all that's deductible when that property becomes an investment. But if you've got an offset account and you use that money to go and buy another home, well, that debt of 800,000 is still there, wasn't paid down, and in essence, that property with that 800,000 debt becomes deductible debt. So, again, a lot of complexity. You need to talk to your advisors. And look, it's always hard to plan 3, 5, 10 years out, but just be thinking these things through. And look, I've got offset accounts. I think they're great. They save interest and they get all that flexibility. I think it's something that, particularly on a home loan, that's where I use it. Sadly, I still have a mortgage, but on my home loan, I've got cash in there, and that's a good place first. And if you had your home loan paid off, whatever, or you had more than enough cash there, happy days. You could do it on the investment property, but I think the home loan's the place to start. Another thing I want to talk about is what impacts people's ability to borrow. I always say that it's the 3 C's, but it's not quite that. It's kids, credit cards, and car loans. Just run us through how, not to stop people having children, but just maybe run through how big an impact each of those can have on your borrowing capacity.
yeah, good point. Kids do have an impact, not as large an impact as you may think, but essentially the banks are looking at your overall position, how many family members there are, how much income you earn, all these things, and they're determining what they think your household will be spending. And when you include more kids, that number increases quite a bit.
So they put an average spend per child, so 10 or 12 or 13.
They group it as a household, but yeah, they call it a HEM, so household expenditure measure. And for every child that you have, that number creeps up higher and higher. So it does have quite an impact. The exact number is dependent on the income of the household and other factors, but not enough of an impact that you shouldn't have kids.
Well, that's debatable. And the other one is, and I think this is potentially something people understand, particularly about credit cards. People go, "Oh, I pay my card off in full each month, so why am I getting stung on my borrowing capacity for that?"
Yeah, good question. Well, you may not always. You can assure them, and that's what history says, but a couple years down the line, something happens, all of a sudden you're not paying it back. So they assume that it's fully drawn, and then they apply a percentage of it on an annual rate for you to essentially pay towards. So they list it as an expense, even if you have $200,000 in the bank and you pay it off every month.
Yeah. And so sometimes people have to effectively cut up and close their credit card accounts, don't they? Yeah. Now, there's nothing to stop them 6 months later opening up another one once you've got the loan in place, but we wouldn't advise that, of course. But people are free to do what they want. But that is sometimes what you've got to do. You've got to get rid of that credit card, even though you pay it off in full. Just use a debit card for 6 months and then reassess your situation then.
Yeah, that's right. I mean, if you have a $20,000 credit card and you're pushing your borrowing capacity, you really want to get that new investment, it could literally be the difference between a major bank and a non-major bank and a 1.5% interest rate. So sometimes you just got to cut it up.
And the same with car loans, even though, how do they assess those? Like the full payment, they take off your income, do they?
They use buffers similar to home loans. So the interest rate's 9%, they might put a buffer on top.
Yep. Okay. So, what about self-employed people? If someone's self-employed, how does that? How do the lenders assess their borrowing capacity? Because income can certainly be a lot more variable than someone who's potentially on a salary.
Yeah, good question. Changes lender to lender, of course. The major banks are a bit stricter with their criteria, whereas the non-banks are quite lenient. You know, they in some cases let you do low doc loans where you're just using bank statements to verify income, right? And back in the day, I wasn't around, but I heard they even did no doc loans, right?
I
So
did. I remember
yeah,
those. Yeah, just set to
you
self-certify. You
didn't
could
get
make the
any of
payments.
those.
No, they're got long gone. You're never going to see them again.
Yeah, yeah. So they tighten up lending rules, which is good. No doc loan is a bad thing. But more to your question, it depends. So with the self-employed income, the key thing is that you engage someone, a finance broker, before you make the changes, because the lenders want to see at least a year, in most cases 2 years of active trading income to verify, there's income here, the business is doing reasonably well, and we can use that for our forward assessment. So you generally need 2 years trading. You need an ABN open for about 18 months as, I guess, a prerequisite for the major banks. So if you're making the adjustment, you need to make sure that you've done what you need to do before you move over to self-employed, whether it's resetting your interest-only terms or refinancing and extending the mortgage, just to give yourself a cash flow buffer so you're not, stuck for 2 years with your hands tied.
And so even if I've been in business for, let's say someone's been in for 10 years and they have like all businesses fluctuate, do they average out a couple of years, or do they just, do you say, when you've had a really good year, that's the time to get in and borrow, or how does it typically work?
Yeah, it's funny. They're quite lenient given it's retrospective, right? Because we're looking at, in most cases, the most recent financial year could be 12 months ago, right? So they usually, if the most recent year is lower, they'll use that. If it's higher, they'll either use that in isolation, which a lot do, or they'll average the past 2 years. But many, many lenders will just accept the most recent at face value, and that's that. Which is good because, economy is doing well. Everyone's businesses are generally doing well. So it makes sense to use a more recent figure, but, that could be very different to what it looks like 12 months from then. So
What would you say to someone who's listened to the podcast? Right around Australia, the median prices are pretty high. We're average of more than $1 million, or median more than $1 million on average across the country. And people think, I can't possibly get an investment loan. What would you say to someone in that situation?
good question. You just need to have the discussion and talk to a broker and an accountant. Yeah, you need to figure out what you can and can't do. And if you can't do anything now, it's simply doing some forward planning. What can we do over the next few years to get us in a position where we can do something?
Yeah. And a lot of people think, if I want to get an investment property, I need a deposit. But most people save for that first home loan, and then the deposit there, even that can be as little as 5% these days, and they might get some equity. Just explain how you would set up if I was going to buy an investment property. I didn't have any spare cash, or not much, but I had a lot of equity in my property. How do you typically structure that?
Yeah, good question. It's back to what you mentioned before about the deductibility with, selling your home versus we're paying it off. So if you've got equity in your home, and equity is the difference between the loan against it and the valuation, if you've got equity, you can actually access that in the form of debt, right? So you create a second loan split against your current home loan, and it's secured against your home. You pull that out, and it's treated as cash in a sense, but granted through a loan, right? And that is then used to fund the deposit and costs for a new purchase, whether it's a 20% deposit plus stamp duty, buyer's agent fees, but essentially does come from your home. Many people, they'll save up, right? They'll say, I need to save up more money before I can get a deposit on investment property. They'll save and save and save. But the reality is, back to what we were saying before, is that money needs to go towards your non-deductible debt, which is your home. So unless your home is paid off, it makes absolutely no sense to put cash towards a property, an investment property.
Yeah, you'd leave that in the offset account if you had one, and get that against the non-deductible debt, and then borrow against the property, and that then becomes effectively, you're probably borrowing 105% of the purchase, including the equity against your current home. So all that becomes fully tax deductible, doesn't it?
Yeah, that's it.
Yeah. So that certainly helps certainly with the pain of negative cash flow. Look, the reality is, on a residential property in Australia, If you're borrowing 80% or more, you're going to definitely have negative cash flow with all the rents and the expenses. So that negative gearing benefit is certainly helps with that cash flow. It's not the be all and end all why you'd buy property, but it certainly does help with the cash flow.
It does. And out of all my clients, I'd say 95%, maybe even more, of their properties are negatively geared or negative cash flow. It's massive. Anytime you're using equity in the form of debt to fund the acquisition costs, it's going to be negative. So you're paying 6% on the interest and you're getting a yield of 4.5%. Right, it's negative. So that actually ties back to what we were discussing before with the entities. If you've got a negative cash flow property in a trust or a company, you're not getting any benefits for a very prolonged period of time versus having it in your personal name where you are getting them immediately. So you may pay a lower tax rate in the company, but how long until it's positive cash flow, right? Could be 10, 20, 30 years. By then you're retired and it's not even relevant. So definitely a discussion
and you lose that capital gains discount as well. So,
yes.
what happens if I'm a nervous borrower? It's a first investment property. Everyone's got good equity generally if they bought a house for 3 or 4 more years ago across Australia. What sort of risk mitigation things can you put in and do you discuss with clients so they can just weather the ups and downs of interest rate cycles and property valuation cycles?
Yeah, good question. There's a few key things. So first is cash flow. Second is the way that we structure the financing. So we want the property standalone and not cross-secured. And the third is cash buffers, right? So depending on the style of property is going to gauge how much surplus cash we have to, manage time frame between tenants and maintenance costs and such. But we always run the cash flow forecast. So how much do we have outgoing on this property? What's our month by month cash flow? And we do our affordability based on that. So we determine it based on that, and then we work back from there. All right, what will the banks lend us? What are we comfortable lending? And then what does that mean in terms of the quality and type of investment that we're buying? So cash flow is probably the most important. Second is structuring. So as I said, we want the property standalone, and that's by doing that equity draw that I mentioned before. There is an alternate to that, which is how the banks will do it, and they'll simply cross the two assets. So it means your investment and your home are linked, and if you default on one, the other's at risk. If you want to fix one or change things or pull out equity, they assess them both as a whole. So very important to keep them separate. If things go bad and you default on your investment and they repossess it, at least your home's safe, right? That's very important. So that, and then a substantial or reasonable cash buffer. Yeah.
I think another thing in cross-collateralization is, and that's one thing we don't like doing at that Momentum Wealth, is the fact that if we've seen it in valuation cycles, if you've got them all crossed and you want to exit one for whatever reason, and the market's gone down, and sometimes it does, in over a 30-year period, you'll see downturns, and you've got to get them all revalued. Whereas if you've got them standalone and you want to sell one or do something with one in particular, well, then you won't have to deal with that asset. You don't have to deal with the other ones. It's just really important for people, even if it's the same lender, you want to try and keep them as separate standalone loans, don't you?
That's right. That's right. I actually had a horror story, and a client had all their properties crossed with a major bank. The banks did that. And it was just prior to some major changes in the lending and compliance environment. And they were all in Port Hedland, right, in high-risk town based on the mining boom. They made a lot of money for a short period of time. But when things went down, they had those. So there was 5 properties in total, crossed in with their home, and they went into very, very negative equity. And the bank was they were close to, and in discussions to repossess their home. So it was really, really bad. But a lot of changes came in. I forget what year it was, but it was when there was a lot of changes in the regulatory environment, and they were just saved by those changes, and the bank had to have a discussion with them and work with them instead of just repossessing the home. So that's a bad case scenario extreme, but something you're trying to avoid.
And I think that's an important thing for people who maybe, mortgage brokers have now more than 3/4 of the market for good reason. But the lender, much as we love our lender friends, their role is to get you into that bank and not let you leave. Every lender I've ever dealt with directly in my journey, and everyone I've spoken to who's dealt with a lender directly, they want to cross-collateralize you because it's almost, if it's
Makes
not
you
written down
sticky.
bank policy, it's implied policy because you're sticky. It's very hard to move. You've got to move all your lending at once. Whereas good brokers will say, it's actually more work for you, isn't it, as a broker?
It is.
To not cross-collateralize, but it's in the client's best interests.
It is more work, but only just a bit. So you can't use it as an excuse. But there's a lot of ex-bankers who are now brokers, and you see it all the time. It's, Yeah, it's good because it's how some of us win clients, right? We have a bit more value to provide.
And so, someone who's you've dealt with people in buying their first home, you've dealt with people who've got lots and lots of investment properties. What advice would you give to someone who's starting out on the journey about how do I become a successful property investor? What have you seen from those people who've got multiple investment properties that's really helped them on the journey and set them apart from somebody else?
It's a good question, Damien. It's the people that the first thing is that people act, right? They see changes in the market, they're in a good position, they're going to act. One of my best clients in terms of their performance, we did a case study on them actually, and they bought 3 properties in 3 years. They bought their first investment, 3 investments that is. They bought their first investment in 2022, 3, one each year after, and it was all from equity growth. They're not high income earners. They're reasonable income earners, middle income bracket, and now their portfolio is worth over $3 million. So for them, it was acting. They didn't overcomplicate it. They weren't trying to optimize everything, trusts, companies, and overcomplicate it. They bought it in their personal name, maximized their lending capacity, and acted when things were good. So it's taking action is the main thing that I see.
Yeah, and sticking to the plan. So many people get an investment property. It sometimes becomes a headache. You've got tenant issues, you've got repairs and maintenance, and there will be times in the cycle where it goes nowhere for a couple of years or could even go backwards. It's just about that taking action and sticking to that. You're not going to get rich overnight in residential property. Sometimes you have great cycles where it goes up quickly, but most of the time it's going to be that 4 to 6, 7% per annum on average. Some years will be 0, some will be a bit more, and sticking to that long-term goal. And you've got to be in it for at least, in my opinion, at least 10 years. Otherwise, it's probably not worth getting into the market.
That's exactly it. Long-term focus. The worst outcomes I've seen are over short turnarounds, people making wrong decisions, getting emotional and exiting the market. In 2019, for example, I've got a couple of clients who did that and they were scared and just didn't know, and they wanted to get out and get their money back. And
they've left a lot of money on the table.
They have. But also don't get stuck chasing the carrot, right? There's a lot of opportunities out there and firms promising something shiny. Property's quite simple, actually. So you make good long-term focused decisions. Don't try chase the next big thing because, as you're saying, it's a long-term game. You're not going to make money overnight. So,
yeah. Good on you, Max. Appreciate all your insight today. Fantastic. And no wonder you're one of the top 1% brokers around the country. You've got a lot of knowledge and you no doubt do a great job for clients. So thanks for joining us today.
Thanks, Damian. Been a pleasure.
While there are a lot of changes happening in the lending landscape, the biggest takeaway is this. Before jumping to any conclusions based on headlines in the media, buzzwords or opinions you hear, speak to your mortgage or credit advisor. It may not mean you can't move forward now. It may simply mean looking at a different lender or structuring your debt differently.